Do you have an FHA loan or considering purchasing using an FHA loan and have questions about the mortgage insurance? Well, in today's video, we're going to discuss FHA mortgage insurance in more detail. We're going to discuss what PMI actually is. We're going to talk about how long it lasts. We're also going to go over a calculation to show you how you can calculate the monthly mortgage insurance as well as the upfront premium when using FHA. And lastly, we're going to talk about how to cancel mortgage insurance when you have an FHA loan. And if you stay tuned to the end of the video, I'm going to tell you why FHA loans and the mortgage insurance really aren't as bad as most people think they are. But before we dive into it, I want to take a minute and introduce myself. My name is Jeb Smith. I'm a real estate broker here in Southern California. And I want to ask a favor. If you're going through the video or as you're going through the video, if you find it helpful, do me a favor and hit that thumbs up. And leave me a question if you have one. I'll do my best to get back to you in a timely manner and help you better understand it. But for now, let's start today's video by talking about what mortgage insurance actually is. So mortgage insurance is a policy that protects lenders against default. What does that mean? That means lenders put a protection in place to cover themselves when you put less than 20% down buying a home. That's mortgage insurance. And it's an insurance policy in case you default on your loan. So if you default on your loan, that insurance policy essentially gets them paid in full. And so anytime you put less than 20% down, and in most cases when doing FHA, most buyers are doing 3.5% down. So when doing that 3.5% down, that mortgage insurance premium that you're paying every month is essentially insuring that lender against default. Now on FHA loans, how long does that mortgage insurance last? It lasts the life of the loan. So as long as you have that particular loan, that mortgage insurance, that monthly mortgage insurance is going to be on there every single month, unless you put at least 10% down. When putting at least 10% down on an FHA loan, the mortgage insurance will actually fall off on the 11th year. So you have to pay it for 10 full years. On the 11th year, that mortgage insurance does fall off. And one thing I forgot to mention is that, in addition to the monthly mortgage insurance, FHA also requires an upfront mortgage insurance premium of 1.75%, which we'll show you how to calculate in just a moment. So the question often comes up, how do you calculate the monthly mortgage insurance or even the upfront mortgage insurance premium when using an FHA loan? So what we're going to do is we're going to go through a quick example here, and keep in mind, I'm only going to do this once, but I'm going to show you how to do it in the description below if you want to calculate this on a loan amount different than the example that we're going to use. And in this example, we're only going to go over the 3.5% down option. If you put more than 5% down, the mortgage insurance premium per month is different, as you'll see from this table here. But in this example, we're using the 3.5% down option because that's what most people use when getting an FHA loan. So in this case, we're going to take a purchase price of $350,000. And so to start the calculation, what you need to do is you need to take 96.5% of that purchase price. So in this case, that number would be $337,750. Why 96.5%? Because when you put 3.5% down, the amount you're financing is 96.5%. Once you have that loan amount of $337,750, you need to calculate the upfront mortgage insurance premium that FHA charges. That is 1.75%. So in this case, you're going to take that $337,750 and multiply it by 1.75%, which is going to give you $343,660. So even though you put 3.5% down, you're actually going to be financing $343,660 because of that upfront mortgage insurance premium. So now what we do is we take that amount and we multiply it times 0.85%. And now that we have that amount of $2,921.11, that is the yearly amount. So in order to get the monthly amount, we're going to divide that by 12, which is going to bring it to $243.43 per month. So on a $350,000 purchase, putting 3.5% down, your monthly mortgage insurance premium is going to be roughly $243 per month for the life of that loan. So now that you know the monthly mortgage insurance premium, the question often comes out, how do you cancel that mortgage insurance? How do I get rid of the monthly mortgage insurance when I have an FHA loan? Well, if you have a loan that was originated, so if you got your loan before June of 2013, if you still have that same FHA loan, if you do, you should refinance, but if you have that same loan, once you get 20% equity in the property, that mortgage insurance will essentially just fall off the loan per FHA guidelines. But most people that have FHA loans today have been originated after that point. Just because of where interest rates are, it makes a lot of sense to have refinance since then. But in order to cancel mortgage insurance as of now, there's only two ways to do it. One is to sell the property and pay the mortgage in full through the sale of the property. And the second is to refinance. You can refinance once you have additional equity in the property into a conventional loan and then cancel out that mortgage insurance. Other than refinancing and going into a conventional loan, there's no way to get rid of the monthly mortgage insurance. And people often ask me, well, why would I do an FHA loan? It seems like a bad deal. I'll have the mortgage insurance forever. It's not really something that I want to get into for the life of the loan. And yes, that makes sense. But keep in mind, most people don't have an FHA loan or any loan for that matter for the life of the loan. So most people are going to end up refinancing at some point if rates go lower, or at some point when they gain 20% equity in the property. And you might say, well, that's going to take forever. Well, think about this. People in Southern California that put 5% down this time last year, just a year ago, now have nearly 20% equity in their property because property values have gone up nearly 15% in Southern California alone. So those people that have FHA loans from just a year ago may be in a position to now refinance, get into a conventional loan, and get rid of that PMI. Now, had they waited and not bought a property because they were worried about the mortgage insurance, they could have potentially missed out on 15% gain in equity. So I wouldn't not purchase a home if the payment made sense just because there's mortgage insurance involved. Your other option is to wait until you actually have that full down payment of 20% so that you can avoid mortgage insurance entirely. But that could be years for some people. So that's why I don't think FHA loans are bad loans. They're a good loan for people that have minimal down payments. They're not just for first-time home buyers. They're not for people with just low credit scores. They're primarily used for people that have minimal down payments. Now, I have done videos in the past where I've talked about FHA loan requirements, and if you're interested in something like that to figure out what you actually need to qualify, you can check this video out here. And then I've done other videos where I've also talked about frequently asked questions that come up when talking about FHA, which I'll link to here. But for now, I appreciate you taking the time to watch. If you're new to me, new to my channel, I often do videos where I help buyers and sellers understand the real estate market. So if that's of interest to you at all, do me a favor, hit that subscribe button. Give me a thumbs up if you haven't done so already. And I encourage you to reach out to me if you have questions. But I do appreciate you taking the time to watch. I appreciate the support and hope to see you again soon. Have an awesome day. Bye-bye.